Okay, so when your business needs cash, you can get financing from your friends, family, and fools. But bank financing is the cheapest and most durable form of financing. I'd like to introduce you to Ash Patel. He's the CEO and President of Commercial Bank of California. He's also the Chairman of Board of National Bank of California and National Bank for Brentwood. Commercial Bank Group has over 800 million in assets, and their loan to deposit ratio is under 60%. So why is the ratio so important? The ratio is important because it tells you how much dry powder the bank has. Ash has over $150 million sitting in his bank ready to loan out. He is actually, like he describes it, it's like a Ferrari sitting in his garage with a full tank and the driver on the seat ready to take off. Ash has 150 million sitting in his banks, not earning anything yet. And he is ready, very happy to lend it out to good business people who could put it to good use. So basically, bank में बहुत पैसा है, लोहा गरम है.
I saw that.
Okay, and when bankers like Ash Patel say no, when they're not ready to give you, when Ash is not ready to give you cash, you go to Brij. Brij will say yes. Brij is the CEO of Alliance Funding, and he's also the co-founder of Quick Bridge Funding. Alliance Funding does equipment financing, whereas Quick Bridge Funding does basically deals with unbankable customers. Quick Bridge Funding was ranked the fastest growing mid-market company in Orange County in 2014, and it deals with, basically it provides loans, immediate loans to, I don't know if I would say immediate loans, but working capital to mid and small sized businesses. A disproportionate number of people whose names are dentists land up becoming dentists. And then we have a person named Brij who is totally focused on bridge financing. And it is no coincidence that both Ash and Brij are Patels. As you're familiar that Patels in this country have done extremely well. And they own over 70% of the motels and hotels in this country. You will find that both Ash and Brij are not going to make loans to people who are not going to pay them back. But if you have legitimate business needs, you can't have a better partner, business partner.
You have to pay it back.
With this, I give you our very own Ash and Brij. So the format is going to be that Ash will present first, and then Brij will present his presentation and his PowerPoint, and then we'll open it up to Q&A. You just have to project your voice and speak louder because you don't have speakers in the small room. Okay then, thank you.
So my name is Ash Patel. I've been here many times at the invitation of Ramesh and Navneet that started this TiE chapter a long time ago. So I want to keep this as informal as I can. You know, bankers are boring by nature. So the exciting field is Brij is fun, exciting field, because when I say no, Brij comes in. So it's kind of an interesting that both of us are sitting there, because banking is completely getting turned on its head, and guys like Brij are eating our lunch, because in terms of what he does, the fastest growing entrepreneur Orange County company is his new funding company, which is like an on-deck company. It's non-regulated. It's completely by what we call Patel underwriting. So I have regulators I have to do, and Brij doesn't have to. So when Karina asked me to come by and talk, I've given this speech many, many times. I want to keep it informal in terms of how you get a banker to say yes. And she's very right. We just closed an acquisition. That's why I was late, because I was in Brentwood. I'm also the chairman of the board of a bank we just acquired. So we had a board meeting, and my secretary texted me at 3:30, because I was in the corner of Wilshire and Bundy, in Wilshire Boulevard and Bundy, in Brentwood at 3:30. And she texted me and said, you have to be in Irvine to give a speech. So I was in the middle of a board meeting, and I said, guys, I have to go, because I have to get on the freeway. So I had to rush all the way back down here, because I respect our Indian community, and I do this frequently. So I'll go through the presentation really quick, but I want to make it very, very informal. So even during the presentation, if one of you want to stop me, then please go ahead and stop me, and we'll go ahead and get things going for here. So a little about how do you get yes. So I know this is a forum for entrepreneurs here. So I put a couple of bullet points up here that just makes it easy for you to understand how could you get a banker to say yes. Now, first and foremost, in our lending business, unlike Brij's lending business, character counts and trust matters. He doesn't care. All he cares is collateral. So if I say no, he's either going to go through a cash flow or he's going to go through a collateral and say yes or no. So in the conventional sense of banking, I think it is very important because we make decisions purely not only based on cash flow and collateral and capacity, but in community banking, unlike leasing and or short-term lending, the character counts. And I cannot tell you how many times in my life I've made a loan to a person that is sitting in front of me that has absolutely nothing but a great story and is hardworking, needs a break in life. He's been turned down by 5 bankers. He's got a business plan. He's got a great idea, and nobody took a chance on him. I'm a product of USA, and I came from Africa, and if somebody along the way didn't give me a chance, I wouldn't be sitting here managing almost $1 billion worth of assets. I started a bank, I sold a bank, I bought another bank. So somebody took a chance on me. So my success is owed to people that took a chance on me along the way since 1986. So I truly believe in giving back. So that's why I meet with all the borrowers. So when I say character counts, it really, really counts. And being human, we're all inhuman. So your banker is the same way. So conveying the trust is extremely, extremely important for our lending platform. And remaining flexible, because I see a lot of borrowers that come to us and said, I have to have this or I need to have this. You know, it's a negotiations between the bankers. You go and say, I want $1 million loan, and I'll say the borrower wants it at 5%, Brij wants to give it at 15%. So it's always a negotiations on collateral, negotiations on cash flow, negotiations on repayment terms. The whole lending is a negotiations. That's why character really matters. The other thing is, in terms of sponsorship, like who are you? The first thing a banker wants to know is who are you? All this is intended to get the banker to say yes at the end of whatever you're asking for, whatever loan amount. Your discussion with your banker is to get a yes at the end. So you're setting up all these little conversations and information so you can get your banker to say yes. So operators' experience matters, the track record matters, because it's trying to convey trust. What have you done? Have you done a successful company? Have you not done a successful company? Right after the financial crisis, we get to hear this a lot in our underwriting standard. If you had a foreclosure, the credit scores messed up, they either got divorced. We're in Orange County, so there's a high rate of divorces. So there's always a story behind lending. So the experience really matters. And then the second thing is, how much money are you putting in the game? So if you're going to apply for a loan, 100% leverage is not really good. We want to know how much are you vested in the business that you apply. So bankers always want to know that is it going to be, they call it OPM, other people's money. We're looking at a loan today. These guys are buying a business. It's an awning business. It's a $350,000 loan. I just tipped live example today at 3 o'clock. He's buying it for $350,000. He's asking for the bank to put $100,000, and the owner's carrying back $250,000. So my question to Greg was, well, I like it, but there's no money in the game. You have no money. You asking $100,000 from me, and the owner's carrying back $250,000, and the business is for sale for $350,000. What are you putting in the business? So having the important part is the skin in the game is extremely, extremely important. Having faith in your banker to repay. So the customer that is sitting in front of you, you need to convey to the banker when the chips are down. You know, the 2007 through 2000, I'll say 11, 12, all businesses were suffering. Everybody wanted to borrow money that couldn't repay. How does a banker then make a loan? How do you qualify to get a loan? So it is extremely important. I'll give you a couple of examples. We had a couple of IT companies I banked. So I have lots of examples to give you. I had an IT company, a startup IT company. When I had my first bank, Premier Commercial Bank, I remember this guy extremely well, an Indian individual. He came by, I made a bet on him. It was a brand new IT company for servicing servers for IBM and HP. We borrowed him $300,000, and 2 years later, the business failed. He had to file bankruptcy. The guy came to my office, and it was Satish. He came to my office and said, Ash, I have to file bankruptcy. The business is failing. I'm shutting it down. But I still owe you $280,000. But I promise you I will pay you back. 2 weeks later, he came back and says, I just took a job at Burger King as a cashier, and my wife took a job as a nurse in a hospital. And for the next 7 years, the husband and wife worked and paid me back every single dollar of the $250 that they owed us. Even though they lost their house, they lost their business, they took a job, but I got paid. So then when I say character counts and I make a bet on him, he says, you took a bet on me when nobody else would have, and he had put all of it in, he did pay us back. So it really matters. The other thing is, what do bankers don't tell you, right? So what we don't tell you, it's important for you to know how our thinking works, how our psychology works. It's important for you to know how we make decisions. I think it's really important. So first impressions matter. So when you go to see a banker, obviously being prepared is extremely important. Having a knowledge of your industry is extremely important. The presentation you make is extremely important. So, unfortunately, you do judge a book by its cover. So the way you present yourself, having the complete command of your industry is important. Relationship also matters. It's important that you build a relationship with your banker. And last but not least, be honest. Good, bad, or ugly, it is extremely important to be honest with your banker. You never want to say anything to the banker that he would find out later and question you that I pulled your credit report, or I did a LexisNexis, or I found out that your house was not doing, you had payments. So the more honest you are with your banker, the more trust you build, the more faith he'll have, the more character you build, ultimately getting a yes to the banker. So I know Harina said I have 10 minutes. I'm going to quickly go through this, and then we'll open it up for a Q&A. Just like what the banker wants to know, I think every borrower should know what the bank is all about. So it's a two-way interview. Before you walk into the bank, you have to understand who they are, what is their legal lending limit. We are not like Brij. When he comes up, he'll tell you what they do. We are fully regulated. Banking, healthcare, and insurance are the three industries in this country that are the most regulated. FDIC insurance that I have, 100% regulator. So if I have a regulatory order, which means I'm under some kind of a constraint from my primary regulator, then there's a lot of things I can do. I can take a bet, I can do projection lending. So it's important because what the condition of the bank is affects your chances of getting a loan, because even if the banker has faith in you, wants to trust you, wants to give you the money, ultimately he cannot. So you may be wasting your time going to a bank that has restrictions that are not controlled by them, government has it. What is their lending culture? It's important to are they an entrepreneurially driven bank? Do they do projection lending? Or are they going to be a conservative, 3-year tax return, successful track record, lending philosophy? The other thing is the people you're talking to, do they have authority? Extremely important. Big banks, we survive because we have single signature authority. Myself is $1.5 million. We combine it with my CCO, 2.5. One more person up to $5 million. We don't have to go anywhere. Up to $5 million, we sit in a room, we have a conversation, and we say we can do it. We shake hands and it's done. We don't have to go anywhere. Above 5 to 15 million is our legal lending. From 5 to 15, it does have to go to a committee. So you have to understand. The other thing is you want to find out if your bank wants to grow. So when Harina sent this, I sent her, she says, Ash, tell me a little bit about what you do. So I at night, late night. So she works very late. I know it was like 10 to 11, midnight, I think. And we're exchanging emails at midnight. So I typed up something to her, said, what do you want us to, how do you want me to introduce you? And she used that exact words in the entire email, that you have $150 million to lend. And that is a true story. We just bought a bank closed December 10th in Los Angeles, and we did a 2015 budget. I'm the chairman of the board of that bank, so I have a management team. So I gave them a goal that I need you to generate $100 million of loan in West Los Angeles. And then I run a bank in Orange County, right here, Commercial Bank of California. So I gave my team in California, in Orange County, a $50 million goal. So when we say we have $150 million, we truly mean between the two banks I control, we have $150 million in 2015 we need to loan out. We've got the capital between the two banks of $80 million, so we can go to up to $800 million in size. When I combine the two banks, we're only 500. So I got capital to take me to 800 because I raised $50 million after I sold my first bank. And I'm under leveraged. Brij will understand, I'm grossly under leveraged. So I have too much capital and I have too much liquidity. So I stand, huh? Yeah, there goes this theory about the Ferrari. So when Monish and I met, I think it was a year ago when I was going through this, Monish remembers, that's why I told Harina. So Monish said, so tell me, Ash, what do you do? And he says, I feel like I have a Ferrari in a garage with a full tank of gas and a driver, and it hasn't been come out of the garage yet. Because I have 80 million of capital, now I have 150 million of liquidity to lend, and a guy that's an Indian guy with the last name Patel. That means he wants to grow, because that's our goal. So our goal is we want to be entrepreneur, we want to grow. So now the engines, the Ferrari that was in the garage, I ended up getting the key to the garage. I'm opening the garage and I'm saying, now let's take it for a spin. So the first 150 million is referring to what we have in terms of capacity when I said that we wanted to grow. The other thing is, what matters in the end? So you go through all that, and how does a banker actually make a call? So most of the times, even if everything is checked out, the banker makes a gut call that, what am I going to do? There are times we meet with people that are very successful and they're extremely arrogant, and I use this all the time, that are play hardball with the banker just because they have a great financial statement, they have great liquidity, they have a great cash flow, but at the end of the day, and I say that character counts, if he is an egoistic person and he's a hard negotiator and he gives banker a hard time, I tell my lenders every day, if this guy gives you such a hard time when you're giving him money, just try and collect money from him at the end of the day, right? Because he says, I don't want to give you collateral because I'm $100 million net worth, give me a better rate, I don't want to give you this because my cash flow is great. So person that sits across the table and asking for money, and he's already qualified to get the money because he knows it, but he has an entitlement mentality, he has an egoistic personality. I've been in banking 30 years, and I've learned long time ago that it doesn't pay. You want to do business with quality people, quality individuals. You have to trust them. Just because they are successful doesn't mean they will pay you back. So the bank I took over here in Orange County, it was started by General Line. Their investors are Donald Bren, Henry Sigestrom. So when I say the company that I ended up running today has, I will call the blue blood of Orange County, are on this company. So it's a really well-known company. And I'll tell you that they lost $12 million before I took over. And that $12 million was lost by giving money to high net worth individuals. Individuals, I just said, just because they have $100 million net worth, they're going to pay you back. They won't. I'd rather lend money to the individual that's going to pay us back. So it does matter. The last C is a very simple technical term. We call it the 5 C's of credit. When you want to see a banker, this is exactly the 5 C's a banker goes to. So when I went to lending school, when I was a loan officer, the first thing they taught me as a loan officer is learn to understand the 5 C's of credit. So I just put them here. This is the secret. If they say, what's the secret sauce of lending? 5 C's. This is the basic fundamental lending 101. They taught that in the first class you take when you do commercial lending, is they teach you what does this 5 C's of credit mean. If you can address each one of them, the likelihood is that you will have a great loan from your customer. Just a little overview about who we are, what we do. We're established in 2003. So when I say top ranked in financial strength, because I have so much capital, we are super well capitalized. We're in the top 6%, so we're very, very safe, well capitalized. So I'll leave it at that, 7:35. So if you have any questions, I will take that now, or I'll sit down and Brij does it, and however Miss President wants it. So we'll do it. Yes. Thank you.
Thank you.
First of all, thank you, Harina, for inviting me. After my speech today, it might be the last invite, but thank you very much anyways. So appreciate it. To be frankly, so I met Ash at an article in the newspaper where I read a Patel. This is when we were just literally 2 years in business. I read that the Patel owns a bank. I go, wow, that's pretty cool. I have to get in front of his face somehow. So I called him, I cold called him as I do, and somehow he was interested because I was Patel as well. And he's literally seen our business grow and scale over the years. So as I grew up in the lending business, I aspired to be that man. Post-crisis and regulations, I have nothing to do I want to do with bank. because his world is way more complex than what I want to deal with. All I care about is making money. So that's a hero of mine over the last 15 years that I've seen him sell banks and do big things, and it's an impressive thing to have access to bouncing off ideas. It's a pretty awesome thing for me as an individual. So my name's Brij Patel. I'm the president of Alliance Funding Group. Our focus primarily is we finance tangible property for businesses. We do equipment leasing, equipment financing. I started the business back in 1998. Prior to that, I owned a leasing company that I ran that for about 2 years and sold that to the investing partner. Alliance has been in business for 16 plus years effectively. Since inception, we've done about $800 million in fundings to small and medium-sized businesses throughout the United States. By nature, a lot of my salespeople focus on different verticals like medical, transportation, manufacturing, information technology, healthcare, but collectively as a collective group of 90 plus employees, we inherently become a generalist. So we finance all asset classes to all SIC codes throughout the United States in various risk grades. And I'll get into the details of it. Good things about us is when a customer wants cheap money, we will finance them at cheap rates and then sell it off to guys like Ash. And if they want to pay high rates, we'll buy it and hold the risk. So we tend to prefer, as a private lender, non-bank lender, we tend to prefer high risk-adjusted returns for the risk that we're perceivably taking. So as Ash referenced to 5 C's of credit, we care about your character, but we care about collateral and cash flow and rate of return more than we care about your character. And that's typically the case with non-bank lenders, as you'll see as you investigate the options, is that the banker truly wants to get all your depository relationship, your commercial real estate lending, your personal, potentially in some cases, your credit card services, and all of the variables. So they're trying to make little money out of a lot of services, where we're trying to grab the opportunity specific that we have in hand. We also co-founded QuickBridge along with my 4 other partners in 2011, and that is ultra alternative lending in small business lending. That business started in 2011. That business holds all risk on balance sheet. Since inception, that company has funded about $250 million on balance sheet. We have credit facilities with banks, and then we borrow and we turn around and lend it to small businesses and medium-sized businesses. That company has about 80 plus employees. That company was 2014 named the fastest middle market company in Orange County. Fastest growing middle market company in Orange County. And we hold all risk. So we've been managing risk throughout the last 3.5 years, and you know, we're in a niche space, and we have a niche within that space that we can scale to 150 to 180 million this year, and in excess of $250 million next year. So I kind of put some funny slides on the top left to talk about just general. Oh my God, everything's, I gotta go through everything here. So liquidity awash, right? Generally speaking, for individual investors and even some cases institutionals, there's lack of yield. Everybody knows their CDs don't yield anything. So money is chasing equities, money is chasing bonds, money is chasing yields in general. So for alternative lenders like us, for us to raise sub-debt and capital and equity capital has become very easy for us. And inherently, once we raise that, similar to Asher's problem, we have to push that out to small and medium-sized businesses. So in generally speaking, liquidity, and mind you that I've been in business for 16 plus years. I've seen the cycle of a lot of liquidity, the collapse of liquidity, and then now it's coming back. That it's just, there's a lot of opportunities. You just, as a business owner, there's a lot of opportunities to borrow. You just got to figure out what your needs are and who does it apply to. If you have an operating history and 5 C's of credit, you go to an Ash. If there are certain aspects of it that you're missing, there are alternative verticals of your need that can be solved through just a little bit of research. Asset-based lending in general, although I'm not an expert in factoring and AR financing, it's available. So as a business owner, if you have a balance sheet and you have some accounts receivable, you can leverage that accounts receivable to go out and get capital. There are bank lenders that do accounts receivable financing, and there are non-bank lenders that do account receivable financing. The difference within the two is banks typically will underwrite conservatively in that segment. Private lenders that do AR financing are very focused on specific verticals. So there are groups that do staffing financing, AR related to staffing companies, and they're just experts at that, similar to how we do equipment leasing. And so they will take a more aggressive position on your AR than a traditional bank may. And inherently, they're going to charge a premium for that risk. Inventory financing, purchase order financing, very standard. Based on the asset that you have, they're going to give you a loan to value on that asset and fund you a present value to that and collect it. And the inventory or the purchase order being as a collateral. Purchase order is a little bit different because you have a performance risk associated with it. My specialty is equipment leasing. What we finance, and there's 7,200 of us throughout the United States, finance is tangible property for businesses. So we do software, IT hardware, furniture, you name it, for a different type of business, we financed it throughout the United States. We do both nonprofit organizations, for-profit organizations, public entities, municipalities. We finance every spectrum of credit profile that you can think of throughout the United States that you can think of. We've funded 10,000 customers, $800 million. So we've done a lot of different credit profiles. There's also in the unsecured working capital space that is really the new hot space that Ash had commented on, is what we call peer-to-peer lending and just non-traditional unsecured working capital options that U.S. small businesses that have available that is also gaining steam. And they're looking to grab market share from loan volume, $10,000 need to probably $500,000 need, where banks typically don't want to play on the averages. Peer-to-peer lending, interesting concept. In a low yield environment, peer-to-peer lending basically tries to connect the investor and the borrower through a platform play. And the platform effectively does the credit underwriting and the servicing of the loan as a mechanism that connects the two together. And the goal is effectively to take the depository institution conceptually out of the play. So lower cost of production, the hope is, lower cost of delivery of credit, lower cost of servicing, and inherently both parties, the investor gets a higher yield and the borrower gets a lower yield, and you have an equilibrium. Lending Club, for example, and Funding Circle are two big players in that. Lending Club just went public about 6 months ago at a valuation of $8 billion. And they do about, I'm sorry? They got, and there's a whole, there's a model issue with it, and we can get into the details in the Q&A, but hopefully I'm part of that industry player, so I don't want to be YouTubed out. But, but it is a model, and there is a value in it. There will be value prop as it matures into a platform that really has brand recognition. Balance sheet lenders, on-deck capital, canned capital, and quick bridge funding. These are alternative lenders that lend based on your revenues and your daily cash flow, micro and small loans ranging from typically $10,000 to $1 million that are literally decision within 24 to 24 hours to 3 days. Money's wired. The payments are anywhere from daily, weekly, monthly, and loan terms are anywhere from 6 months to payback periods are 24 months. And it's a very simple process where the underwriting is more focused on your revenues and the velocity of your revenues and daily cash flows than it is on the credit or historical issues with the business. So that is an option. Very expensive cost of capital, but it's an alternative option to kind of what we call, for us, it's the bridge funding to get past the problem, get on to the next issue. So both in form of asset-based lending and unsecured working capital, there are a lot of options for alternative non-bank lenders that are available to small and medium-sized businesses out there. So Ash would always say no dirt, no deal, or banker typically says no dirt, no deal. Our comment is no dirt, deal, because ultimately we don't like real estate. We don't like real estate because it takes, the entire process is 90 days, and we're not interested in doing anything that takes 90 days. You know, for Alliance specifically, a deal that starts and funds within a week or two is something where we want to do business in, because we want to monetize the asset and move on to the next opportunity. So we're very volume-driven mindset. Within the leasing industry, kind of give you a little bit of background, there are lots of options. Leasing and financing of equipment is kind of the generally is known as leasing or equipment finance industry. There's the captive lessors. Captives are like when you buy a Ford Motor Credit or Ford car and you're financed by Ford Motor Credit, that's called a captive. It's inherently owned by the same holding company, and one finances the need for the other. And there's the subsidy of the rate, 0% financing. There is no such things as 0% financing. One is subsidizing the yield for the other. So captives in the leasing space for businesses are like people like Cat Financial, Cisco Capital, Siemens Financial. Ultimately, the good thing about captives is that they provide easy access to if you're buying their solution. The drawback inherently is if you're buying non-Cisco equipment and need Cisco Capital to fund it, they're not going to finance you. Similar to Dell Financial Services. So a lot of the tier 1 manufacturers of all asset types for business-related assets, you will have a finance company that funds that purchase, right? Inherently, if you're buying a competing product, that captive will not finance you. So you have to find an alternative solution. Bank lessors, huge industry. The collective leasing industry is about a $200 billion industry. So it has a massive traction as it relates to financing business owners' capital expenditures. Bank financing, one of the largest lenders, Wells Fargo Equipment Finance, Bank of America Capital, and there's hundreds of those. The benefit with working with them, price. They will inherently give you the lowest price possible, but if you miss one of the bullet point data points of the credit underwriting, or 4 of the 5 C's you have, but you miss one C, they won't not only not finance you, but they won't guide you to what your alternative options are. So then you have the independents. And the market's a pretty mature market. Over the last 50 years, the market's created these segments for it to ultimately provide a solution to the end user or business owner. Independents are people like Alliance. That's the other leasing company that I own. And Leaf Financial, Great America Leasing. These are independent leasing companies that effectively, based on their balance sheet strength, borrow money from people like Ash and then loan it out to small businesses in the hopes of getting a quality risk-adjusted return on their capital, right? The benefits, credit flexibility. So guys like us typically work with equipment dealers that have a grade of credit need. They typically sell to A credit customers, B credit customers, and C credit customers. So they prefer to work with guys like us versus typically a captive or a bank financing, because a multiple credit window is more important to them than a rate or price. The drawback with guys like us at the core is price, because inherently we're going to want a little bit larger return for our risk, because we know that you've gone through the gauntlet. You've gone to Ash said no, and it's gone through the process and you're coming to us, and inherently there's incrementally more risk. The level of due diligence he does is substantially more than the level of due diligence we do. And kind of going to the specific to the product, for example, our products, and this is not just Alliance leasing companies in general that have some scale, would have application only up to a couple hundred, $200,000, $250,000. So on a single page application, as a small business owner, if you're buying equipment, you should be able to finance that on the average for $250,000 without much more than a one-page application, typically, right? Middle market financing in leasing specifically is $250,000 to $5 million. That process is very similar look and feel to Ash's process of complete packet, 3 years of financial statement, operating history. Where we differ a little bit is that we have spectrum of lenders that will do transactions that are maybe potentially balance sheet is overly leveraged, but they have good cash flow. Collateral is weak, but they have good cash flow. The cash flow is light, but the collateral is strong. Where we can make the story happen is in what we call truly a story credit, where one of the pieces makes sense to guys like us, and we can underwrite to that and structure the deal around that. Alliance specifically has financed a lot of franchisors that are first location startups, but the owner of the business that's starting the franchise has a lot of personal liquidity from previous job and or entrepreneurship. So we know that the guarantee is worth something, and SBA is not doing it for whatever reason, we'll come in and step in and inherently ask for a good rate of return, but provide liquidity when nobody else is, right? Lease types, without boring you with all the lease structures, we do, and a lot of leasing companies do all types of leases, on balance sheet, off balance sheet. Different businesses, as we've learned over the years, have different drivers. Some have cash preservation mindset, seasonality of the business mindset. Leases and loans and equipment loans can be structured to meet the business needs cash flow wise. So there's a lot of options for small and medium-sized businesses alternate to a bank financing. The process, you know, he would want your DNA, I wouldn't, right? So that's at the core. The process for borrowing $250,000 in equipment financing typically is a page of application, what kind of equipment you're financing, and the approval time frame is typically 24 to 48 hours, and funding is upon delivery. And the leasing company will typically handle progress payments. If we're talking about, you and I have talked about solar in the past, if the install process was 90 days out and the manufacturer needed progress payments, the leasing company typically should be able to handle that for you. Middle market leasing is a segment that, so Alliance currently has about 90 plus employees, 75 are focused on small ticket leasing deals from 10 to 250, and then our middle market group out of LA, that's about 15 reps, and we're scaling that group out. It's about is focused on transactions from 250 to 5 million. And that process, similar to bank underwriting process, requires 3 to 5 days in credit underwriting. But within that statement, we also have niche lenders that will do collateral specific, leverage specific opportunities that even a traditional bank couldn't underwrite to. Similar to that product, the funding is upon delivery, but we can do the progress payments if as needed. Pricing on the small ticket financing, typically with a leasing company or finance company, is going to be 6% plus on a small ticket opportunity, sub 250,000. Pricing on the middle market can be as low as like term swaps and 250, so that puts it at about 4.25, 4.5% APR. So it's not a, but it's a very tight window. And then within that statement, if the credit profile shifts, then the rates get up in the high single digits. All right. So if you don't call us, I actually like this tagline a lot. So if you don't call us, because we're an outbound shop culture, we don't wait for people to call us, Ash. So my tagline was, if you don't call us, we will, and hopefully often, because we have 50 reps that will dial small businesses every day, all day, 100 times a day. So, okay, so thank you.
That was very informative. Thank you so much. So we open it up for Q&A now. I'm going to get this podium out of the way. Questions, Dinesh?
For Ash, are you restricted to Southern California only, or you are free to move anywhere? No.
So I have one of each. So I have a national bank, which is the one in LA, that can do nationwide lending, and the California State Bank is a state bank, which is sort of restricted, but not really. If the principals are domiciled in California, then we can go out of state.
I think the question is both of you, but mostly to you. Would you finance raw land, maybe 50% loan to value ratio? Anyone?
He doesn't like dirt.
No dirt.
We would, depends on what it is scheduled. If it's a spec development for house, a spec development for apartments, what is it used for?
It's a raw land.
What are you going to do with the raw land?
Obviously develop it down the line.
Yeah, but what into what?
Building development, housing development.
Yeah. So
basically warehousing for a while.
Okay.
Yeah. So basically looking for price appreciation
looking for
of
land
land
bank.
as well as the development profit.
So they call it land banking. So if you're doing land banking,
Yes.
if you're not going to have any development plans within 12 to 24 months, then I wouldn't be. Because I don't want to land bank somebody that's going to hold on to a land before the cycles turn. If you have a land that you want to buy, you put 50% down, it goes to the plan, permitting, zoning, have a project, then I want to do that. So holding on to the land till the values come up and you're going to flip the land, then we may, I'm not.
Not necessarily flip the land, but develop it maybe 4 or 5 years down the line.
24 months is our tolerance. So on raw land at 50%.
Thank you.
Yes.
Yeah. So Ash, I came up to you earlier during the break.
I thought ask everybody so everybody gets the benefit.
So from a collateral perspective, if somebody's looking for line of credit, say $1 million, established business, how do you look at, or how critical is collateral? I mean, obviously, the finance business from an equipment perspective, I buy a lot of, in fact, we finance through Dell. And
We can beat them.
Okay. but
And we can meet here.
When we approve you.
collateral.
Lines of credits are a very important piece of business for the bank. It's called CNI, it's a commercial industrial bill. In the current environment, and even previously, if you look at a banker, and I just gave this to a speech today to our board of directors, that given equal choices in doing real estate or a line of credit, I would pick a line of credit. And the collateral there is your business assets, right? So it doesn't necessarily have to be supported by real assets, meaning dirt, as Brij calls it. When we take receivables, inventory, fixed assets of the company, and then on a full recourse basis, meaning it's going to be personally guaranteed, that's what I'll look for first and foremost. So I'll give you under what conditions that would apply. So you have a business that is 3 years in business, revenues are trending upward, gross profit margins are stable or trending upward, and you have a stable net earnings number. And then you have a leverage ratio, so the total debt on your balance sheet is less than 3 to 1. And it could be more than 3 to 1 for asset-based lending, factoring it's 4, 5 to 1. We would. So that's a very attractive feature, a $1 million line of credit to a successful business that wants to go to a bank and said, I want to borrow $1 million to support growth or support acquisitions or support, in his case, buying new equipment. So we would be interested. So it would depend upon what the real purpose is. If it's to support working capital, yes. If it's to support an IGL, it's called an internal guidance line to buy equipment, that would be yes. So it's not as necessary to have hard collateral, meaning real estate to back up your line. If you have a successful track record of generating cash flow, because unlike Brij, he gets paid by repayment, liquidation of collateral. I can't be in his business. I don't want to foreclose. I don't want to pick up the press. I just want you to be successful cash flow wise, pay me back. I'm not in the liquidation business. I'm not in the foreclosing business. I don't know. I need a guy like Brij. I bet on you to succeed on your cash flow so you pay me back. Now, as a default, I hate it when this happens. I have to foreclose, go after you, go after your guarantee, liquidate your business to get paid. That's the worst thing I want to do. However, it's part of the business. We have to account. So hopefully that answers. If you give me more specific, I can give you even more specific answers.
Thank you.
All right, thank you. So Molly, get his business right.
So Ash and Brij, why don't you repeat the question when you hear it for the audio video? Yeah.
Sure. Did everybody hear his question?
Just repeat it.
His question originally was, what collateral do you need as a banker for $1 million line of credit? That was his question. So the answer I gave you was a question that says, what do you need for $1 million line of credit? For a growing, you said, profitable, successful company.
On a motel financing, goes on the property and or the income statement. Which one you work on?
Both.
Both.
So we just call like Brij, I call it the Patel underwriting. So I'll look at your NOI, do a 35% cap and do a 35% NOI on the revenue and do a 12% cap as my liquidation value. So it's not really our going concern. It's really on the appraised value of the real estate. Depends on the brand. Is it a franchise? Is it non-franchise? Depends on the location.
Say non-franchise.
Independent. Independent. How many units? 10, 20, 30, 50 units? 30 units? Yeah, we'll loan on real estate. We are Patels, like Harina said, we control what, 70% of the hospitality market. So it's in our DNA to loan money to hotels. We grew up in it, so unfortunately it's a moniker that Patels have, Patels Hotels. So we are very good at loaning money to motels and hotels.
I miss my boat, man.
Yeah, as a Patel, you did miss your boat.
Are you the good one, or the Ahoa
Yes.
has a more better financial
Excuse me?
In a
organization?
single family home, do you guys, there is a card, TiE in the personal level home finance?
Uh-huh.
Do you guys do same thing for that business level?
Yes.
Repeat.
Then what?
Your question is that would we do like a home equity line like we do it for a personal, can you do it for a business? That's the question, right?
Yeah.
Yeah, absolutely.
How much percentage do you guys look for? I know 30% is common for bank or first loan.
Yeah.
How much leverage you guys can do?
65. If it's owner user property and you want to do an equity loan for your business, we'll go to 75. So 65 to 75, depend on the collateral. If it's a non-owner occupied investment property, apartment, storage facilities, we'll go to 65. If it's owner user, multi-use, we'll go to 75. Sometimes 80, depends. I get pushed by my people all the time. It's Orange County, owner user, brand new tilt-up construction in Irvine Spectrum. Why can't you go 80? I just did an 85. I speak for my boats. I want to do it 75, but we had a transaction that came across, brand new piece of property, $8 million, are competing with JP Morgan, 80% loan to value on a new company. And I said, we'll do it. We did $8 million at 80% LTV on an industrial building, on an equity, second trust deal. Yes.
Will you lend on 50 homes free and clear, separate homes, not one loan, one loan?
Depends how much leverage you want to put on that.
50%.
Of the value we would create, get an appraisal. Huh?
Let's say 10 million.
Yeah.
Will you give a line of credit, or how you will?
We'll give you a business purpose line of credit rather than because depends on the single family home. We have this HMDA regulations. Like he doesn't have any regulations, I do. So if it's a single family home used for primary residence.
No, these are all investments.
So it's empty. Are there rental in there?
No, these are rental income.
There's a rental income in there.
Yes.
Would Brij like to take the same question?
No, we just don't do anything with real estate.
He does no dirt.
No dirt. No dirt. I mean, I like the opportunity, though. Individually, I can figure something out if he doesn't lend it to you.
Yeah, I feel discriminated against. There's no questions for him.
They're scared of the high rates.
So the answer
He's targeting wrong audience.
Yeah, so the answer to your question is yes. Banks don't like to do that, but there's a term he uses. It's called a warehouse line. So we do have individual investors like you that I've given them a line of credit, say $5 million line of credit, and all they're going to do is acquire housing, like BlackRock did, or like right now Carlyle did. All the private equity companies are out there with a lot of capital and liquidity. All they want to do is acquire rental properties because the banks are foreclosing on them and they can buy it at a great price. It's got an NOI coming out of it, and they want to acquire them because it's a better return. You get 4%, 5% return than 1% in the bank. So it depends. The answer is yes, we would do it.
Okay, another question number 2. Will you do construction loans?
Yes.
That's a Brij question.
No dirt.
Construction.
No dirt.
It's too long. The accounting process.
Yeah.
Well,
He wants quick money.
I got something for Brij.
Thank you.
Thank you. Thank you.
So, in your presentation, you had PO financing, right?
Correct.
Yes.
So, in my business, we sign like 3-year and 4-year contracts with hospitals. Some of them are county hospitals, district hospitals, well funded, and usually I'm getting like $15,000 to $20,000 a month. And it's a 4-year contract, so the overall PO I can show you would be like $73,000.
Sure.
Yeah.
So something like that, what kind of terms can we expect for PO finance?
So let me comment. So what is your end delivery? Is it service or product to the end user of the hospital?
It's actually a software as a service business.
Okay. So there's some level of innovation in equipment financing to even finance SaaS contracts. So inherently the risk.
We have a hardware and software as
Got
a solution.
Yeah. And I, you know, I make a joke, but we can do low rate financing. We prefer to do higher rate because we make more money, right? Surprise, surprise.
Making money
At all. We do love money. So, you know, we finance Memorial Care, UCI Med Center, and we can. So going back to your question, a SaaS solution that has software, hardware, and consulting component to it, that the customer pays you, let's assume $10,000 a month, assuming that contract has a hell or high water clause, the inability to back out of the contract, and assuming you as a business have sustainability, performance risk is taken out of the formula, meaning that you will deliver a solution to the end user, the entire whatever that contract value is, you can present value that today at the hospital's credit rating. So let's talk about and fantasize for a second the Hoag Hospital, for example. That's a AAA rated credit. You can easily finance them at sub 4% cost to capital. So whatever your contract with them is, assuming fixed monthly payments over 3 years, you can present value that at 4 or 5%. And at a certain core, if it's a really good credit, it doesn't matter what the collateral is. It could be 50% hardware and software and 50% professional services. We'll monetize that for you. So if you have further questions, let me know and I can help.
Brij, I'm working with a solar company.
Yeah.
And we have several proposals with motel owners, mainly Patels.
Yeah.
And we show them there is a benefit that they can derive while saving the energy.
Yeah.
But they don't want to put any money down, even though they may have money. So would you finance that under 6% or 4 years, 5 years?
You can. The challenge, and Harina and I have talked about this, the challenge with solar financing, the ROI in alternative energy, specifically solar, is in excess of probably 8 to 12 years in sense of loan amortizations, that the ROI for small project is just not there. So if you look at solar energy financing in a very macro level, there are a tremendous amount of lenders like PNC Energy Capital, GE Energy Finance, and many others that finance projects in excess of $5, $10 million, where the asset itself, the financing needs to be amortized over 15 years, taking into account tax credits, all those attributes. There's an ROI for the end user. Problem with a $100, $200, $300,000 project, when you amortize that financing over 5 years, no matter what the rate is actually kind of irrelevant. It's the financing, the cost, the debt service on the financing over 3 to 5 years is so high that the customer actually is negative cash flow implementing the project. So what we need to do is work with Ash, and we can create a product and corner a middle market and have high yields, because I know you like that too. There is a play. Ultimately, what it needs to have is a residual on the financing, kind of a balloon payment for it to make a cash flow sense from a sales perspective. When you go to an end user and you say, well, your energy bills are $5,000 a month, well, the solar financing will be $7,000 a month, he's like, no, get out of here. At the core, right? If you can say your energy is $5,000 a month and your lease payments will be $4,000 a month, he's excited because he's saving $1,000 a month one. And everybody will do that. Everybody will do that deal. So at the core, the smaller market and middle market for energy doesn't have long-term amortization. The collateral inherently has nominal value. So it's really being able to stretch the term out a little bit longer to justify the financing.
Can I ask a question? So in terms of the Patels that own hotels that want to put ICAM solar, and they don't want to put any money down, what are the barriers to their decision? Is that they don't want to put any down payment on the solar panel, and then they want to take a longer financing? Because there may be a way to do this, depends on what the size is. I want to understand where the pain points are, where the tension is of why Patels don't want to do that.
They typically look at the payback period for themselves, if they are taking a loan or something like that. So as long as it's a good payback period, they'll go ahead and,
So what if it's a 10-year payback, fully amortized 10 years?
10-year would be a good one, yeah, for them. But the problem that I've noticed is that somehow the interest rates, like you mentioned, you know, the bill payments, the loan payments are higher than their bill payments, so they just can't justify taking a loan. So the interest rate has to be right where they are paying like 10-20% less.
You've obviously done the analysis. What's the interest rate that needs to be at? And at what duration?
I would say the SBA loans would work pretty well.
Yeah, so you see the SBA has a program at Prime Plus 1, fully amortized 10-year equipment loan. If you do that over the cost of the utilities on a commercial basis, it may be that their loan payments could be equal to or less than the utility payment.
We just have to strike that formula right and then...
And reduce the interest rate, because you can't touch the amortization, but you could play with the interest rate.
Also, I think SBA is, the loans you give are like 5 years for equipment financing, right? 10
You
years?
can go 10 years.
10 years, yeah.
Now, there's a new legislation that Obama just put in the, and there is a new program, what they call a 504 equipment loan program. That's a 25-year deal. So you now have, or the conventionally they used to have, is for a building, real estate building like this, you get 25 over 25, 25 due in 25 amortization. And equipment is usually 5, 7, 10. But they want to promote small business growth, right? So they're saying that the equipment that he wants in 24 months paid, I can do it for 25 years.
25 years. Yeah. And the interest rates are for this 25 years?
It depends on if you can get the debenture for it. It could be as low as 3% fixed for 15 years.
We know where to go.
So, and I want to comment on the amortization.
Hold on, it's a small thing.
Yeah.
Typically, it's a 90, at the 50-40-10 financing, right? So the 100% financing that you are looking for. So there's a first piece, but it's a first trustee, a first UCC filing. Then there's a second debenture, is one way to do it. Or I think it's 90 to 95% financing. I don't know if there's 100% financing on the 504 yet, whereas SBA 7A can do full, but you understand it's a 25M.
Correct, that's pretty good. Thank you.
Thank you.
Another option to comment on that is that you can use the tax credits as a lessor. So why to convert to a lease versus a loan is to be the rightful owner of the property, take advantage of the tax credit, which enhances your yield.
Yes.
And then lease the equipment to them.
But the bank takes the tax credit, or the owner?
The bank can take the tax credit because bank is the rightful owner of it. And I can
because I have the collateral for it.
Yeah. So there's a way to defer tax liability.
So this panel just saved me money.
I'm telling you this.
Would commercial bank be interested in taking the tax credits?
Yeah, we make money. So, in fact, I was looking at 3 tax credits today. Like, I'm making money. I don't want to pay tax.
How about Mackers? Can you take Mackers also? The depreciation, equipment depreciation.
We don't own it. We don't have. We have a.
Oh, you're leasing it. Yeah.
If you have leased it, then
I can take Mackers. I can because I'm not the rightful owner. I just have a lien on the property, and I can take the tax credit as a lien holder. But it doesn't. I'm not the legal owner.
I have a question. Does your bank has acted as a preferred lender for first-time buyer for the new homes? Are you completely doing that?
No, we're not. We're a small commercial bank, so I don't do any home loans. Period. I just don't. I'm not in single family owner-occupied residential financing.
I'm talking about 15 different homeowners wants to finance it, each one separate.
Can't do it.
You don't.
I can't do it. I'm not HMDA approved. I don't want to go through this. I have enough trouble with regulations already. So, it needs to have lots of scale to do HMDA approved loans. And I just made a decision for both my banks. We had a couple of guys pounding the table, and I said, we're not going to do it. It's too much trouble.
Yes, both of you, do you put a clause for personal guarantees on any of your funding structures?
So for us, the alternative financing, for us, I would say probably 80% of the time our leases and loans have recourse by the principal and or principals of the business. There are scenarios where the credit has large enough and enough scale, i.e. a Memorial Care or institutional credits where we don't require recourse. But if it's closely held company, Small Business USA, sub $10 million in revenues, we're probably going to get personal guarantees.
So my answer is it depends. The bank I just started managing, I never did unsecured non-recourse lending until I started hanging out with the rich guys. And this bank was very famous for doing what you just asked, was total non-recourse lending, $5 million, $10 million to high net worth individuals. So this bank had the DNA of unsecured lending, non-recourse. So real estate, for example, 50%, 40% LTV, and I would want that plus personal guarantee. And in the bank we are at right now, we are very comfortable. So we just did a couple of lines for very rich guys of 5 million, 7 million, fully unsecured, no personal guarantee. So it all depends. So we're not saying no, but it's got to be triple gold plated in my mind to say, I don't want to give you a guarantee. Yes.
So TiE is about entrepreneurs and startups. What kind of startup plans you have for new entrepreneurs who don't have yet 3 years of records, but they have the passion, they have a business plan, and they have the character? How would you help them?
So I would do that. We started this whole conversation about doing that. So the business plan would be the first one. So it would be an SBA loan, right? So understanding what marketplace you're going to be, what market share you're going to have. You have projections. So you're talking about 100% projection-based startup, right? So it would depend. So like I said in my slides, that you have to have at least a expertise in the business. We need to know that you're going to be successful. So for example, if you have a hotel manager, we do that all day. So when you have a gentleman that's been a desk clerk for 10 years and then wants to start buying a hotel, his first hotel, then we'd say that makes sense because he knows the business. For example, you have a restaurant guy that's been in the front desk at the Burger King and then wants to buy his first Burger King. We could do that. We've got a lot of, we're Indian, so software companies come up all the time. They have this wonderful new software. It's first in market, and now with technology today, smartphones, this, that. It will all depend upon the dollar amount. So when we take those risky bets, the rates are a little higher, and the loan amounts are smaller to start with. So I'll just give you a little amount to get you started, and I call it was a proof of concept. So you have a concept, you have a business plan. I'll give you just enough money to prove your concept. Because I know, when I underwrite that, I write it at 100% at risk. It's 100%. The day I give it to you, I know you're going to screw up and you're not going to pay me. That's how I look at it. Because you have no collateral, you have no cash flow, and you have no history. So it's purely a bet on you, right? So they'll make a small bet on you first, in case you fail. Under 350,000.
Very big.
So let me add that a little bit. So private.
So that's personal guarantee or?
With personal. I want you and your first one and everything you own and not
DNA.
There is no free lunch.
My shirt.
There is no free lunch. So let me add that a little bit.
My smile won't matter.
There are also non-bank private lenders that will lend on franchise concepts and business models based on the performance of the franchisor. So what we grab when we're underwriting these types of scenarios where it doesn't fit SBA, for example, because SBA has certain guidelines that says this deal, even though startup and it fits, because of this specific business model, they will not finance that credit and or that business segment. There are private lenders that will finance them. And what we leverage off of guys like us, leverage off of is performance of the franchise disclosure documents to performance of the aggregate franchisees, and bet off that. But that being said, the structure around that with personal recourse is high. Alternatively, also for early stage companies, if you've secured, and this is just throwing out ideas for people that may be seeking this option, is people that have secured venture-backed funding, institutional, not friends and family capital, but institutional capital. There are also venture-backed financing available in the marketplace, where you can do traditional CapEx financing with early stage companies that have operating losses, but they have liquidity from a partner of the business, which is the venture fund that's funding it. And the way that world works is basically the burn rate of the business. It's losing money, how fast it's going to lose the capital, and our leases and loans will be financed shorter term than you run out of money. And it will be inherently high rates and warrants.
Good. Thank you.
Yeah.
My question is for Ash. What would be the real difference between applying for a loan to a commercial bank on a normal basis versus SBA?
What is the question?
What would be the difference in applying a loan as a normal dirt loan versus a dirt loan from an SBA perspective?
SBA doesn't do speculative lending on real estate.
No, I'm talking about you have a business, you have operating owner-occupied property,
Yes.
which has already a loan right now from a commercial lending, which is not an SBA loan.
Correct.
If an owner wants to do the owner-occupied 85% loan to value or more liquidity out, and it's a reputed business in terms of a medical doctors, like what you probably could put into A-listing category, great credit, no issues with nothing, What would he has to do to get SBA lending on that to take a longer leverage, as you said, 25 years and pull out the 10 years balloon payment loans out,
So the question is a very good question. So it's a question of leverage, right? So conventionally, banks don't go more than 65.
Right. Plus 10 years and 25 years.
Yeah, you got a 25M due in 10, right?
And payable in 10.
And payable in 10. So it's very important. There's legislation being introduced yesterday by the new Jobs Act that addresses that exact same question. So the 504 is purely for acquisition. 90% financing on real estate is purely for acquiring real estate. So as little as 10% you can put down, and you can get 90% leverage in a tranche called 50, 40, 10. 10% equity, 50% first, second trust deed, a debenture second. But that is only for acquisition financing. So SBA is coming out, 504 coming out for refinance. So if you have a property right now that's got 60% leverage on it now, and you want to go from 60 to 85. So hopefully it goes through. Then it's called the refi 504. So the equipment we talked about is in the same bill that says we want to do equipment for longer period of term with no down, and we want to do refi, high leverage, bring in more money into the economy, but we're taking more risk. And the reason we are doing this, the government is doing that, is because there's more confidence in the employment, the GDP, the economy is coming better, so there's more confidence in the small business and real estate value. So you don't have values that are shrinking now. So real estate values now either stabilize or going up. So the government is coming up with programs of how can we, now that the market is stable, add more leverage. And the bankers are saying, I don't want the leverage. I don't want 50, I don't want to go 85%. I don't want to take the risk. So you, Mr. Government, help me on the refinance side.
So as of right now, there is no product for refinancing to 85%.
Conventionally, no.
No, I'm talking about SBA, conventionally.
SBA on a 504 basis, you do have it.
But that's only for purchase, right?
That is only for purchase, not
so
for...
there is no product available in the marketplace for somebody to go 85% from existing 50 or 55% leverage. No. Not yet.
Not yet.
Thank you.
And he doesn't do dirt, so he can't.
No.
I'll give you a short-term loan.
Now, there is a structure, if I may ask you. We did that for motels all the time. There's a conventional, we get innovative because we are Patels, right? So when we see things like this, I go, there's got to be a way to do this, right? So we did it for Patels, all the guys with hotels in the early 2001 through, I'll say, 6 era before the world changed. And there was an AB tranche structure. So what we do is an AB tranche, meaning that we do a 65% conforming first trust deed. And then I'll do a second piece for 25%, a shorter RAM. So I can go first trust deed, fully amortized, 25 due in 10, up to 65, and then the second trust deed, fully amortized, 10-year, small tranche piece on top of the first tranche, and now you have an 85% loan. But the second piece is fast burn rate, so it burns off very quickly.
That is not an issue, but there is a chance of getting to 85%.
Right.
Right. Okay.
So for the right credits, I did that for a couple $100 million of motels that wanted to leverage it up, and the burn off is either fully amortized 5-year, fully amortized 10-year, and I'd put a small sub debt on top of my primary debt.
And what's the limit? I'm looking for about, say, in the range of asset value of about $3 million as of today.
Perfect size. Anything under $5 million, something around under $1 million second. So combined LTV would be like $6-7 million bucks. So if you were to ask me, you want to do it for 5, I don't want to go with large properties because something goes wrong. I take a hit on both. I get wiped out. The bank gets wiped out.
Thank you. So you guys talked about the unsecured lending market growing, and you gave us an example about lending to high net worth individuals. But other than that example, can you give us any more examples of what would be a legitimate case for an unsecured lending to happen?
Well, I talked to my colleague over here because the fastest growing company in Orange County is a company that's what it does. It does no income verification, and it'll give you up to $350,000 on a one-page application. If you don't call that unsecured quick lending, I'm not sure what you do.
Yeah, we approve customers in 2 hours to 24 hours and wire funds within 24 to 48 hours.
Unheard of, right? This is extremely innovative. That market is extremely hot today, and the regulators and the legislatures are watching this because these are called no income verification. You're making the old home loans where you had Alt-A paper or subprime lending. All you're doing is doing an algorithm and you're loaning money out. And there were hundreds of millions going at it. There's now billions going in it. It's a bubble. And if it's not managed correctly.
So in your case, sometimes the collateral, like in the AR or PO, may not even be there. You would still go ahead and do an unsecured.
Correct. So there are, in general asset-based lending, there are banks that finance asset-based lending, and there are non-bank lenders that do asset-based financing. The space that I was commenting as it relates to quick bridge funding is ultra extreme of that, meaning that we literally look at the business cash flow. We grab all of the credit attributes via APIs, real time. It goes through our scoring model, and then we adjudicate a credit decision and wire funds, electronic document signatures and wire funds.
And there's no collateral.
100% unsecured, but you are shaking like a Dun and Bradstreet.
We're doing all variables.
But
we're looking at criminal reports, we're looking at personal credits, business credits, all the attributes, and rendering a decision almost real time. We believe that because the risk is on balance sheet, we still add the human element to it. So we have a kind of credit policy around that we underwrite to. And it's not just us, it's the space collectively. There are lenders like Lending Club and On Deck that do it comparably efficiently and at lower rates than we do. We just buy a higher grade risk pool.
So guys like him keep me awake at night. He scares me.
It's good.
Can I classify you as a hard money lender? Is it a correct?
Well, I can also lend money at 4%. So, yeah. So I have a good grade. When we aggregate and buy on the leasing side of the business, we aggregate and buy leasing portfolios. We wholesale these pools of assets to banks. We sell to Wells Fargo's of the world. We sell to TCF Bank of the world, Bank of the West of the world. We get rates that are cheaper than you because we're just a larger customer. So those wholesale rates, we can make a spread even by charging customer 5%.
He's a perfect. So I have liquidity. It's at some point. I can't loan my money out, so guess what I'll do? I'll go to him, all the paper he's got on his balance sheet, I'll take $50 million, put it on my balance sheet, give him back a spread.
And we do that now. So we aggregate a pool of assets on our balance sheet, and then we'll hold and age them, and we sell it to banks currently.
Because it's seasoned, so the risk of default goes lower.
Ash can make a risk-based pricing decision between a framework. I will go from 4% to whatever you allow me to, and my gap is larger. So my profitability and opportunity is larger, and inherently will take a higher risk position.
But then at the end of the day, you will hold the risk when he funds gives the liquidity.
Oh yeah. He'll come after me.
Yeah, he will not hold the risk.
No, he'll find me.
Yeah.
When I borrow money from a bank, it's a full recourse loan. So I'm personally obligated.
You're the gentleman with the goatee.
Oh, yeah. So a question for Ash regarding the small ticket loans for startups. What kind of collateral requirements are there for SBA loans? I don't fully understand what's behind this personal guarantee. Could you explain a little bit?
So everybody heard the question, what kind of collateral is on the small business startup loans? The policy, SBA's SOP says all available collateral. That's the standard language, the pure language stated that what collateral, that's a good question. We get asked that and we have to answer that take all available collateral. So everything you have that you can pledge, that is pledgeable, I want it.
Your firstborn also, right?
Yeah, that's I said, every available collateral.
But from a practical perspective,
You don't have anything. I agree.
Is there like a preference that it has to be a certain amount in the savings account, or it's a home equity and so on?
So the target for SBA lending is 100% collateralization, they call it. But for startup projection-based new entities, you never hit 100%. The goal is to get to what's called 100% collateralization, meaning we give you $350,000 loan to start, there should be enough collateral on the table up to 350. So I have a loan for 350, collateral's 350, now I'm at 100% collateralization. That's the target. In new companies, you never hit that because you're trying to build the collateral to get to that level. You don't have it. So SBA's requirement is for the lenders that have PLP is take all available collateral up to 100% of collateral.
Which means, even if somebody says, okay, I have a savings account with this much collateral, and so then that's enough, or you still need like a home and so on.
So we look at your personal balance sheet, and we look at the business balance sheet, and we look at all the equities you have, cash. Usually SBA does not want cash as collateral because it gets locked up for a long period of time. If you give cash as collateral, you can lock it up for 25 years or you lock it up for 10 years. So that's a bad proposition to lock your cash up for 10 years because that's the repayment source. And then you can bifurcate the collateral pool. So I can take 3 years later, I'm going to give you your cash back. So cash is as a conventional lender, I love cash. As an SBA lender, I hate cash because it's not, it's not good for you. So in that case, it's just all the available collateral that you have. And if your houses are leveraged, we have equity in it. So we have to determine the equity in your assets and then take it. If there's no equity in it, then we can just make a case that you have a house worth $300,000 and your loan is $300,000. There's no equity, then I don't have to take anything. But if there's even $10,000 equity, then I got to take a second on your house.
I have a question for Brij. So you graduated from Cal State Fullerton?
Yeah.
And you amazingly just started this business. You never worked for any other company.
No.
What was your motivation?
So money.
It's simply focus on money.
So I actually studied accounting. Wasn't smart enough to go through the CPA exam process, and I realized pretty quickly I worked as an assistant controller for a at that time public company, and realized that I would have to kiss a lot of butts and climb a lot of ladders to get to the promised land of making money. So I saw an opportunity to go into a sales profession of selling financial services, effectively leases and loans. And a buddy of mine got me an interview at a growing company, started that, and then thereafter the Patel and me took over to start my own.
So how many years in your sales profession?
9 months. And then I realized, okay, all I do is make phone calls and I do it myself.
And what was your funding like to start your business?
I think initially I started the business with $30,000 back in 1996, and I sold that business for $200,000 in '98. Started Alliance with $50,000, and now we're funding $75 million this year, and the company's doing really well.
Amazing.
Great success.
So if
The last question for Ashish. Okay. Yeah. Do you do international lending, international investment lending?
No, we don't do international lending. There is an EXIM program from SBA that provides the receivables for. So while I say no, I can potentially do it. I haven't found one that I find interesting to do it. But I was just in India for 2 months, so it is intriguing to do international lending.
One last question.
Yeah, the last question.
Seems like it's very popular.
It's a complete U-turn. Since you have 150 million to loan out, well, that's the problem. What if you cannot loan out? What will you do with the money?
My investors don't get the money. So it is invested right now at 22 basis points in the Fed funds line. So it's not exactly zero. So what I end up doing is it's a lost opportunity for me, right? So I have $78 million, $80 million of investors' money, family-owned money. A couple of guys gave me $80 million just to combine these two banks. And obviously my goal is to give them a return, not as high as his, but my goal is to give him a sustainable.
You consider giving the money to somebody like Monish to invest and, and multiply it or whatever?
I'm in his business. He doesn't give me enough returns. Monish is, I've seen them. By the way, personally, I am with Monish. So professionally, we cannot. We cannot invest in, so we have restrictions. We have government restrictions of where I can put my liquidity.
Even for high net worth individuals that just have any part with you, even still you have to follow the same restrictions.
Yeah. You'd go to Monish directly.
No, I'm
Or go to Tony directly. Right? Tony does the same thing. Well, thank you so much for taking the time to come here.